Alright, so let us first look at the first case. The selling division has the following cost information. Direct material $25, direct labor cost $20, variable manufacturing overhead of $25, fixed MOH $10,000, the maximum capacity of the selling division 1,000 units, actual production and sales of 700 units. So this means that the unused capacity for the selling division is currently 300 units. Now, purchasing division has ordered 300 units to the selling division. In this case, what is the minimum transfer price? We are going to assume that there is no alternative for using the unused capacity for the selling division. And the purchasing division can sell the final product at $100 to the external customers. Okay, so using the minimum transfer price calculation, let us first break down into two different costs, incremental cost per unit and opportunity cost per unit. So each unit incrementally would have three different variable costs incurred, DM, DL, and the variable MOH. So that's going to be $70 per unit. How about the opportunity cost? In other words, are there any contribution margin that the selling division is giving up by selling to the purchasing division in the organization? And the answer is no, because as it's stated above, there is no alternative for using the unused capacity, right? I mean, if they were able to use the unused capacity to sell off to the external market, then of course, for sure, they are losing some contribution margin if they are selling to the internal division. But right now, for the unused capacity of 300 units, there's no other alternatives. Meaning, opportunity cost is simply zero by transferring it to the purchasing division, right? Well, the minimum transfer price is also going to be $70 per unit. Now, there are two different questions. So if we set the transfer price to be the minimum transfer price, then what is going to be the incremental profits or loss made by each division? So first off, from the perspective of selling division, the price is $70 and the cost is $70, which means there's no profit or loss. It's just going to be zero from perspective of selling division. How about from purchasing division? Now they can sell at $100 per each unit, and they are purchasing at $70, meaning for each unit, it's going to be $30. And if they're gonna be able to sell $300, it's gonna be 30 times 300, $9,000 in total. Now we have a slightly different scenario where we have an opportunity cost of leasing at $9,000 for the unused capacity. So the incremental cost remains the same, which is 25 plus 20 plus 25, $70 per unit. And then the equation looks slightly weird, but we're gonna use the aggregate term. So $70 times 300 units, which is $21,000. Opportunity cost is going to be $9,000, right? So the minimum transfer price is going to be based on the sum of the incremental cost and opportunity cost, which is the total cost, right? And we're going to make it by each unit. So we're going to divide by 300 units to reach $100 per unit. So this is going to be our new minimum transfer price. Next, we're going to assume there is no alternative for using unused capacity. So this is the same scenario as the first case. But then, instead of ordering 300, now the purchasing division has ordered 500 units, while the unused capacity is only 300, right? So then what happens? Well, first of all, let us also use the same incremental cost number, $70. Now we're going to replace 300 with 500, right? So $35,000. And then for the opportunity cost, for the unused capacity of 300 units, it still remains 0, but the 200 units is for the margins that the selling division is giving up to the external market, right? So selling division can actually sell at $100 to the outside customer, meaning that for the 200 excess units, they're going to be the contribution margin lost, right? So contribution margin of 100 minus the variable cost $70 times 200, so $6,000. Now then the minimum transfer price is going to be the sum of these two divided by 500, reaching $82. Okay. So here we are seeing a slightly different scenario where we see an excess capacity if we are going to fill the old order of the purchasing division of 200 units. In this scenario, then we are losing the contribution margin to the outside market by $6,000. This is something that you need to take into account. We're going to look at another case. This company has two divisions, as always. Now, the division A has the following cost information. DMDL, the variable MOH. Okay, so the 3 would be $35 per unit. And then fixed MOH will be 2 million. Fixed non-manufacturing overhead 400,000. And variable non-manufacturing overhead $2 per unit. Division A, which happens to be the selling subunit, has an annual production capacity of 400,000 units. And now they're currently selling 300,000 units at $60 to the outside customer. Okay. Division B can purchase the same components at $50 and sell the finished goods at $70. So since it's a slightly imperfect market, the price is slightly different, although it's the same component. $60 for the selling subunit when they sell, but from the perspective of the purchasing division, they can purchase the same component at $50. So this can only occur if the market is imperfect. Now the division B plans to propose division A to purchase 100,000 units. If division A decides to internally transact, it can avoid the variable SG&A costs, and there is no alternative use for unused capacity. Now there are three different questions. What is the division B's maximum transfer price? So maximum transfer price can be between minimum of the external market price and the contribution margin by selling to the external market. But here, it happens to be the case that there is no contribution margin we can infer from this question. So the only thing we see is the external market price of $50. So that's going to be the maximum transfer price of division B. How about division A's minimum transfer price? Here we are going to apply the incremental cost plus the opportunity cost approach. So the incremental cost of by setting this internal transaction is going to be the variable manufacturing cost, which comes from these three right here. 20 plus 10 plus 5, manufacturing cost, right? And then there is no variable non-manufacturing cost. So this is slightly an error here. It's not necessarily overhead, right? It's the variable manufacturing cost of 35 plus the opportunity cost of 0. Why? Because there is no alternative use for unused capacity, as always. So the minimum transfer price is going to be $35. Then the question is whether the internal transaction can occur, and yes, as long as it's within the range of 35 and 50, right? Now there's another hybrid pricing question. If the two divisions negotiate on $42 per unit, which seems to be within the range, how would it affect division A, B, and overall company's earnings, right? So now let us look at division A and division B's change in operating income. So from division A's perspective, they're now earning $42 per unit, while the incremental cost is 35, right? So it's going to be 42 minus 35 times 100,000 units. So $700,000 would increase in their bottom line number. Now from division B's perspective, now they are actually buying at 42 instead of 50 from the external market, right? So 50 minus 42 times $100, 100 units, $800 increase in OI. How about overall company's perspective? Now, from the overall company perspective, it doesn't really matter whether they transact in 42 or 60 or whatever. What they care is insourcing cost versus outsourcing cost, right? So when they were outsourcing, they were able to outsource at $50, but now they can insource at $35 instead, right? So the increase in OI is going to be 50 minus 35 times 100,000 units of $1.5 million. So as you can see, every division and every company overall is gaining a profit, so it's a goal congruent decision to negotiate on $42 per unit. Make sense? Okay, now we're moving on to a slightly different situation. Instead of Division B planning to propose Division A to purchase 100,000 units, they are now purchasing at 200,000 units, which apparently exceeds the unused capacity, right? So, wow, what will now happen? The maximum transfer price of 50 remains the same, but in terms of minimum transfer price, it's slightly different, right? So right now, let us think about an aggregate cost term instead of per unit cost. So the variable cost, manufacturing cost, will be 35 times 200,000 units, so $7 million, right? And the opportunity cost would come from the cost contribution margin lost by not selling to the external market by 100,000, which is the excess capacity, right? And that will be $2.3 million. So now the minimum transfer price is going to be 7 million plus 2.3 million divided by 200,000 units that's going to be internally transacted. So $46.5. Internal transaction would only occur as long as it's within the range of 46.5 and 50. Now let us look at the same situation. if the division negotiates on this range, $47, how would it affect division A, B, and overall company's earnings? First off, from division A, now they are earning 47, and the cost is going to be the incremental cost plus the opportunity cost of 46.5, right? Times 200,000 units. So there will be a $100,000 increase in OI. From division B's perspective, instead of acquiring at 50, now they're acquiring at 47, right? So 50 minus 47 times 200,000 units will be $600,000 increase in OI. So overall, the company's earning will also be the following. Insource at $35 instead of outsourcing at $50. So you may think it's only going to be based on 50 minus 35 times 200,000. But you also have to make sure that overall there's also a contribution margin lost by doing internal transaction by 100,000 units, right? Which is the contribution margin that is lost by not selling to the external market. So that's going to be the contribution margin to the external market of $23 times the 100,000 units that you're giving up, right? Then that will be $700,000. So always division A OI plus division B OI will always be equal to the overall company OI. And this case also shows the goal congruence situation. Okay, so that would be all for 23 chapter.